A Discussion of Central Bank Operations and Interest Rate Policy by Warren Mosler and Phil Armstrong. The Impact of Quantitative Easing. In the aftermath of the crisis, central banks attempted to support increased bank lending to the private sector for the further purpose of supporting aggregate demand. The poster child of these policy tools was quantitative easing, QE, in which the central bank bought government bonds from banks and from other private sector financial institutions. While theorized channels from quantitative easing to aggregate demand have yet to be detected in practice, quantitative easing did have an effect on the rate-setting process for the Fed funds market as illustrated below. The extensive purchases of government bonds by the Fed increased the supply of reserves, shown by S2, which then exceeded the demand for reserves at all interest rates and, had no action been taken, would have resulted in the overnight rate falling to zero, as reserves did not earn interest at that time. In order to prevent this outcome, the Fed initiated payment of interest on both required and excess reserves. The Fed was thus able to regain control of the Fed funds rate by introducing a deposit rate on excess reserves equal to the policy rate, the so-called floor system. Lavoie, 2010. The entire basis of quantitative easing was another demonstration of central banks failing to grasp the same fundamental that central banking is about prices, interest rates, and not quantities. Central banks engaged in quantitative easing to add balances to reserve accounts as they removed equal balances from securities accounts, theorizing that increased reserve balances per se will somehow result in increased spending in the economy. The most recent narrative was called the portfolio balance channel, where Fed purchases of Treasury securities would cause investors to instead invest in riskier assets, which would thereby support investment spending. However, subsequent supporting data has failed to materialize, which should have been no surprise. Lending for investment has never been constrained by reserve availability, and if there was a desire to borrow for investment at a rate high enough for banks to make a sufficient return on equity, the banks would make those loans regardless of the quantity of Treasury securities outstanding.